Hello and welcome to a special digital assets episode of S&P Global Ratings Fixed Income in 15, a 15-minute chat with a market voice and an S&P executive. My name is Joe Cass. I head up the market outreach team here in the UK, and today I'm joined by Raoul Pal, founder of Real Vision, and Dr. Mohammed Damak, a senior director in the financial services group at S&P Global Ratings. So first of all, thank you very much for joining me today, Raoul and Mohammed.
Great to be here. Thank you.
Thank you.
So before we start, just a quick reminder, as always, that the views of the external guests on the show today are their views alone and do not represent the views of S&P Global Ratings. Okay, with that out of the way, Raoul, let's kick off with some questions for you. Would you be able to give an overview of your background in the market, what you're doing at Real Vision, and also how you initially became interested in blockchain and crypto?
Yes. So my background is finance. I'm 30 years of the finance industry. Back in the 90s, I started and managed the hedge fund sales business in equities and equity derivatives for Goldman Sachs. I then, in the early 2000s, went to GLG Partners, which is now Man Group, which was the largest hedge fund firm in Europe at the time, where I started and ran their global macro hedge fund. Then I moved to the Mediterranean coast of Spain, sort of semi-opted out of the rat race and started writing macroeconomic research for the world's biggest global macro funds, hedge funds, sovereign wealth funds, family offices, that kind of thing. So my background's basically 30 years of global macro. Then I'd gone through the financial crisis in 2008, and I was, one of the people who was kind of at the epicenter of predicting what was going on. A lot of people in the film The Big Short were kind of clients of mine, and I kind of knew a lot of how this might play out. The same happened in 2012 when Europe almost fell apart. So I was thinking, why me, living in a beach town in Spain? How come I've got all the access? And people in the street would come up to me and say, well, why didn't we know? And I thought, there's something wrong here with the distribution of information, that only some people could get it and others didn't. And that's why I started Real Vision. So Real Vision is basically a video-on-demand platform. Well, it's actually larger. It's now a broader media company that basically concentrates on helping other people gain access to the world's most preeminent intelligence, financial market intelligence. And we do that by interviewing the world's most famous hedge fund managers, independent analysts, strategists at length. Also in that journey, so I had a journey that I wanted to help educate, level the playing field, and understood that the world had changed away from the intermediaries to a disintermediated world. And I wanted to play a part of that, and video was the big answer. But in that journey, having gone through those two huge crises so close to each other, and having almost lost the banking system in Spain, I started a journey of trying to figure out, could I set up the world's safest bank? I know that's a slightly kind of crazy, arrogant thing to think, but I thought I'd give it a go. So we got together with a bunch of others, and we went around the world to Singapore and the Middle East and to Switzerland and the US trying to do this, and it became hard. And one of my clients at the time kind of tapped me on the shoulder and said, you should look at Bitcoin. Maybe this is your answer. So this was 2012. And so I learned about it. I invested in it for the first time. It went up 100% in a month. And I closed my position, took my money and went, wow, okay, this is not normal. And then I kind of did the first analysis of stock to flow, meaning I looked at it like gold and thought, well, with this much supply and this much gold above ground and this much known reserves, if we imputed the same thing for Bitcoin, when gold was at 1,300, Bitcoin should be at 1 million. So I'm like, okay, this is interesting. This, from a macro perspective, looks cheap. So that started my whole journey. And I also realized that after 2012, the next global recession would see this parallel financial universe using blockchain technology meet this macro world of excessive debts, a financial system that's somewhat fragile, and all of these things would have a horizon point. And that all happened last year.
Great. So, Mohammed, what is our current view of the digital asset universe, both on centralized assets, like a potential central bank digital currency, and decentralized assets, like cryptocurrencies such as Bitcoin, as Raoul just mentioned?
Thank you. I think if I have to borrow a sentence from what Raoul said, this is not normal. I think for cryptocurrencies, S&P Global Rating has been clear in its opinion. We consider them to be a speculative instrument and not a payment instrument. And if you look at the price, it's extremely volatile, as shown by the recent trend. But despite this volatility, the impact on the financial system is quite limited. And that's because the market cap of the 5,500 cryptocurrencies outstanding is fairly limited. I think it's around $2 trillion, less than the market cap of a large tech company. And we're of the view that the ones exposed in case of volatility in the pricing would be the retail investors. Banks could be indirectly exposed when the retail customers use their credit card lines in order to buy cryptocurrencies, or the banks that are planning to start to offer crypto ETF or derivatives or whatever could be exposed to the risks of mis-selling of products. And there are other flows in the cryptocurrencies. But the real disruptors is not cryptocurrency, it's central bank digital currency, tokenization, and more generally, the blockchain technology. Now, let me say a few words on each of them. Central bank digital currency, I think it resolves from day one some of the issues related to crypto and even stable coins. It resolves the volatility issue. One digital dollar will always be equivalent to one digital dollar. And it comes with day one acceptability, as long as it's not perceived as a tool by the government to monitor what users are doing with their money. There are different model of adoptions. There's a disintermediated model where the accounts are opened at the level of the central bank and then managed by the central bank itself. There is an intermediated model where banks and NBFI open an account and manage the client-facing service, and the hybrid model where the accounts are opened at the central bank and then managed by the banks and NBFI. In the first and last model, I think banks' activities may be significantly disrupted. In the second model, banks will probably keep their role, and I think CBDC will eventually replace cash and not banks per se. And we believe that this is probably the most likely model that would be adopted by the central banks. The other real disruptor is tokenization. Tokenization is the process of creating one or several digital representation of a physical or non-physical asset. It's interesting because it allows the fractionalization of an asset and can improve liquidity. For example, if you take an asset that is worth $1 million, want to sell it, if you want to sell it in one single go, then probably the target market or the number of investors would be much limited than if you try to sell it in the form of 100 tokens of $10,000 each. And that opened the door for a broader investor base. It can also enhance the efficiency through the reduction of the number of intermediaries and the shortening or making the process of clearing and settlement more efficient than it is today. Finally, blockchain. I think it is also a real disruptor because it helps the traceability of the transaction, as each and every transaction need to be documented in the distributed ledger. Now, there are some challenges like the method of validation, which is important, whether you go for a proof of work or proof of stake. But in terms of application, I mean, sky is the limit, from trade finance to digital bonds.
So, Raoul, how do you think the digitalisation of finance, including blockchain, tokenization, crypto, etc., could impact such a huge asset class like the bond market in practical terms?
So at top level, the internet grew at an adoption rate of 63% a year from 1999 to 2000. That was the fastest adoption of any technology the world had ever seen. Crypto, in its broadest sense, is actually growing at an adoption rate of 113%, twice the speed of the internet. So this is of an order of magnitude none of us have ever seen before. And most of our narratives are somewhat behind what's actually happening because so many people are working on this. But what I think is going to happen to the financial industry, I think it's actually going to change all global business models. But to the financial industry, we know some of the big problems that have been outstanding. Things like rehypothecation. You know, what happens at things like DTC level, CC level, or Euroclear? You know, who owns what asset? The ability to tokenize these assets is a game changer. And the ability to trade 24 hours a day instantaneously and fractionalize it is also a game changer. So I can't see any reason on earth, while all equities and all bonds are not going to go into the blockchain. We've also seen the rise of DeFi, and that's decentralized or somewhat centralized lending protocols and borrowing protocols that work algorithmically, seem to be pretty robust as far as we've tested, and that looks like that will scale as well. So what we're doing is we're creating a modern system of finance that's more accountable and suitable for the modern age, that doesn't have T+1, T+2 settlement, but instant settlement, that allows the instant transfer of assets. And once you blend in the central bank digital currencies, you've got rails of which all of this can operate globally. So if we think of the size of the asset class today, and Mohammed said, or it's around, or you said that it's somewhere around $2 trillion. If we look at the global equity market, the global bond market, global real estate, which can also be tokenized, all of these things, they're between 100 and $200 trillion assets. If we look at the adoption rate, it's kind of suggesting to us that this blockchain technology is going to end up as a $100-200 trillion asset. I think it actually encapsulates all of these other asset classes because it's a much more efficient way of transferring, owning, proof of ownership, all global assets. So I think it's really big and it's hugely disruptive. As Mohammed said, we don't know actually what format the central banks are going to do this. My guess is they'll start with the non-disruptive version, as he suggested. I think they will move towards the disruptive version. We're already kind of getting noise of that out of the US, that maybe they want to do it in conjunction with the private sector. Maybe DeFi is an efficient way of doing it and fintech is an efficient way of doing it. Do we need money center banks? Okay, that's a big change to the world. Or money center banks have to reinvent themselves. That's fine. That's what technology does. It strives all of us to improve our business models or adapt. So, yeah, look, it's really exciting times for finance, and it's bigger than finance itself.
Absolutely. So, Mohammed, what kind of headwinds does cryptocurrency face, both on the centralized and the decentralized, before it reaches that higher level of adoption?
Thank you. Yeah, few of them. I think the first one is the flawlessness of the technology. I think stability of the network, security, latency, the method of validation, and ultimately the scalability are important technical challenges that need to be overcome before any significant takeoff of these instruments. Second is the regulatory environment. Regulatory environment should be conducive. For example, recognizing these instruments, recognizing the rights of the holders, what dispute resolution mechanisms are available, all the issues related to anti-money laundering, counter-terrorist financing consideration. And this is where CBDC comes with day one resolution of some of these issues on the regulatory front, on the AML and CTF consideration, etc. For tokenization, I think another challenge is the presence of a central counterparty with sufficient credibility to act as the custodian of the tokens and preserve the rights of the users. I think people would feel much safe if their tokens are sitting with a central counterparty that is credible enough to keep them and to maintain their integrity, rather than sitting with a random exchange or a random company. For the central bank digital currency, I think what is important is also convertibility at par, the trust in the underlying technology in the issuing central bank, the fact that it should be available for offline transactions, the fact that it should be neutral and do not crowd out the private sector solutions. And last but not least, I would talk about the ESG consideration and the impact of these instruments on the environment because of the high electricity consumption and the waste generated by some of the cryptocurrencies, for example, through the mining. And here, investors that have ESG consideration, and there's more and more of them out there in the market, are excluding cryptocurrencies de facto. Because of their high electricity consumption, because of the high amount of waste they generate. And what we've seen is that this high electricity consumption is sometimes related to the validation method that is used on the blockchain network, the proof of work, where everyone on the network could validate transaction, versus the proof of stake, where you have a limited number of super users that could validate transaction. And once these are resolved, I think skies is the limit, and it goes from pretty much anything from art to digital bonds.
Thanks, Mohammed. So, Raoul, Mohammed mentioned ESG. There's been kind of a lot of noise around the ESG, how it factors into crypto and blockchain over the past kind of 2 or 3 months. I'd be really interested to know kind of what your perspective is on that topic.
Yeah, firstly, I think we need to be careful in what we compare. Right now, we're not comparing Bitcoin or crypto to anything. We're just saying it used a lot of energy, right? Same as when we use kettles. My guess is global kettle usage is probably higher than Bitcoin. We just don't think of the world in those terms. How much does the banking sector use? We don't know, right? It uses electricity. In fact, it uses electricity and stores it. It basically mines electricity and turns it into bytes, and that's transferable. So that's where part of the value proposition of Bitcoin itself comes from. But transactions are not highly cost. They don't use a lot of electricity. It's only the mining that's expensive, and it's only for Bitcoin, because Bitcoin is a particularly kind of pristine way of doing things that requires a huge amount of computational load. So that's expensive to do. So, okay, so there's only Bitcoin with that, because Ethereum is moving to proof of stake, but it also has side chains and other things that are very efficient in terms of energy use. So most of the whole Rails, so that's why the EIB used Ethereum for their, foray into digital bonds, because, it's not very energy intensive compared to most things. So that's okay. So really that story goes around Bitcoin. But when we dig into the story of Bitcoin and its energy use, as I said, part of the value proposition is that. But if you look at the speed of which Bitcoin mining is moving to green energy, is probably faster than any other industry in the world. Why is that? Because all the costs are in the electricity, and the cheapest marginal cost of electricity in the world is geothermal and hydropower. So we're seeing a lot of that, and then there's new technologies in gas flare-offs. We've seen huge wastage of energy, also load balancing for electricity networks. So we're finding a lot of ways of actually making either existing networks more efficient by Bitcoin mining, or by actually driving the technology to greener sources. So we're seeing this big rise in Canada and Texas. Canada because they've got gas flare-offs, or they've got geothermal or hydro, and it's cool so you can run servers. Texas, huge amounts of gas flare-offs. Or when we go to Iceland and other countries in the north, even in Russia, we're seeing all sorts of different uses of electricity. So net, it's actually a disruptor to the energy world. And I think it's less intensive. And Ethereum, which is really the Rails, the platform for most of the industry, where a lot of the financial sector will start to focus its efforts, that's much, much less intensive anyway.
Great, thanks, Raoul. So, Mohammed, we've published a series of publications. It's called The Future of Banking. So, what are some of the kind of key takeaways that you would highlight from that series of publications?
Yes, absolutely. I think like many other industries, and the most obvious example that comes to mind is the music industry, banks and financial markets will either disrupt themselves or will get disrupted by the fintech and the technological innovation. I think the time where banks were perceived as impenetrable fortresses is definitely gone. And banks and other financial players have been losing business to fintech and big tech companies, and it is just the beginning in our view. And because this is relevant for their creditworthiness and to determine the risk of tech disruption in each banking market, we assess the current state of technology, regulation, industry, and preference in what we call our TRIP analysis. Now, in technology, we ask ourselves the question of how advanced the bank's overall technological capabilities are and how supportive the country technological infrastructure is. In regulation, we try to determine to what extent the banking regulation and the national laws protect the bank's market position or encourage innovation. In industry, the idea is to look for to what extent the banking existing structure, profitability, and strategy support their ability to invest in digitalization and adjust to a different and more challenging environment. And finally, in preference, the question is how likely the customers are likely to embrace new technology and possibly switch to non-bank competitors. Now, we've published more than 25 trip analysis around the world, and the conclusion vary by region and country. For example, for my region in the Gulf, we think that payment services and money transfer businesses will be the areas that will be disrupted. In the US, we think that banks will have to continue to heavily invest in their digital capabilities in order to remain competitive with peers and keep abreast of innovation in data science and technology, and also meet evolving consumer preference. In the US, we think that the retail customers will become more demanding of digital product and functionality and innovation over the coming years, and that goes for all the demographic segments. Finally, another example is the French banks, where we think the universal model and the revenue structure have created some protection against disruption in the lending business. But we think that there are additional risks in the retail segment that remain. We also think that the banks there face the challenges of reducing their costs and replacing their outdated core banking system. Finally, we think that some regulators are protecting their banking systems, while some other regulators are more pushy toward disruption. I talked about the trip analysis, but in addition to the trip analysis, S&P Global Rating has published on many disruption-relevant topics such as cloud adoption, cryptocurrencies, CBDC, and tokenization.
Great, thanks, Mohammed. So, Raoul, I know you're in kind of daily discussions with the market around kind of the digitalization of finance. So what's the mood around digital currency, digital assets with the investors that you're speaking with?
It's fascinating because we've just gone through this 50% sell-off, and normally in markets, 50% sell-offs create a different investor psychology. I've not seen it. You know, I spend a lot of my time speaking to these world's largest hedge funds. You know, I present to a lot of asset management firms, the entire firm, all of their portfolio managers. And I've done that around the world for various people, helping them understand, you know, the benefits of holding some of this stuff in portfolios, for example. And I see nothing but ongoing adoption. I don't see anybody. I see people being slowed down by the ESG story, and I think you'll see over the next few weeks the Bitcoin miners getting together to create a better understanding of what's going on and how it works. So that you know, regulation. People are waiting for more regulation, as Mohammed said, because some people need clarity. A lot of the hedge funds don't, but the institutional asset managers do. I see nothing but people thinking that it diversifies their portfolios and has great portfolio effects for them. They don't need to allocate a lot of money, and they don't need to make the decision that we're all thinking about is how big is this disruption. They just can make the small step. Most haven't made the small step yet. The hedge fund industry and the family office industry has. The asset management industry is only just starting. The first step will be Bitcoin, then probably Ethereum, and then it'll be an open conversation of, can we treat this like real-time mark-to-market VC, and can we bet on protocols, tokens, and ideas that may disrupt our whole industry, and so therefore we benefit from the disruption. And I think that's where it's all going to go. Very,
very interesting. Okay, now we've got time just for a couple of the non-market related questions. So Raoul, I know we've only got a couple of minutes to answer this one, but I've seen you discuss the exponential age. So how do you think technology and digital will transform our everyday lives?
I think many investors misunderstood what happened in the last 20 years with these big stocks that came out of the birth of the internet. Google, Facebook, Apple, and there's a whole bunch of them. I spent a long time trying to understand what that was. What really happened there? Why did we all misjudge it and say, well, it looks ridiculous. Amazon's worth more than every bookseller in the world. This doesn't make sense to me. And so many of us missed it. And the reason being is I think the global business model changed towards network effects. So when you use Metcalfe's law to value the value of a network, it's very different than using net present value in cash flows, right? We all got that wrong. The market got it right. But now we're in a situation where we've just invented cryptocurrencies, which are actually entirely driven by network models, and the key benefit that the model derives is the value of the money goes up. Okay, that's a very powerful model. But that's also happening at the same time we see massive adoption of technologies. So we're going to go from very few electric cars to, by 2030, 65% of every car in Europe being electric. We're going to see a mass change in how we generate electricity, a mass change in distributed computing power, a mass change in genetics, robotics, artificial intelligence. These are all adoption model businesses, and they're all coming at the same time in a 10-year period, which will be the fastest pace of change any of us have ever lived through. It's going to be quite hard to navigate, but also incredibly rewarding if you're on the right side of this. If you realize that the worst words in finance this time is different, that this is a different model, and network models are very different than cash flow models.
Great. So, Raoul, working remotely or working from different locations is a much more kind of realistic proposition for many working professionals across the world now than maybe it was even kind of 2 years ago, 3 years ago. So you moved from London to Spain, I think, and maybe Spain to the Cayman Islands kind of 15-ish years ago. So interested to know, what's the best thing about living in a tropical paradise like Little Cayman? And do you miss anything about living in London?
So I live between two islands, Little Cayman and Grand Cayman. Little Cayman's the island of 140, Grand Cayman's a very kind of advanced place where, you've got amazing supermarkets, amazing restaurants, everything works. What it gives you is some mental clarity because you're away from too much of the noise. But it also gives you access to lots of incredible people. In Grand Cayman, there's a lot of incredible people here, building amazing businesses, doing all sorts of stuff. Half of the center of the finance industry, that certainly the legal and accounting center, is actually based here, which most people don't realize. So it's great. It gives you the fact that every weekend you're on a Caribbean holiday, but I can connect with the world. I can be on a flight and be in Miami in an hour, direct flight to New York in 3 hours, direct flight to London, or a bunch of US cities or Canadian cities. So I'm super well connected here. I've got a quality of life, which I think is where the world needs to move towards, but I'm incredibly connected to everybody. So in terms of what do I miss from London, I mean, I don't miss the weather, and I don't miss the greyness of the, of the endless suburbia outside of the cities, and I don't miss the slightly miserableness of English people when faced with opportunity. They're like, well, it's never going to work. I've kind of enjoyed being liberated from that. I've enjoyed living life in Technicolor, Spain or here. It's bright, it's vibrant, people smile. But obviously, I miss friends, and the culture of England is something truly magical. You can't replicate it anywhere. That culture that England has, that depth of it, the diversity of culture is just phenomenal.
Great. So, Mohammed, as society starts to kind of very slowly open back up, what kind of activities, what kind of occasions are you looking forward to going back to the most?
I think Raoul definitely got me curious about visiting Cayman Islands. So I will definitely add it to my long list of countries that I'm due to visit once we go back to normalcy. I'm really looking forward to the end of the pandemic and going back to travels and discovering new places in the world and new cultures. I'm also really looking forward to being able to reconnect with my parents and extended family physically and without screens. But it's true that thanks to technology, we've been able to navigate through these difficult times.
So, Raoul, last question goes to you. So, on this podcast, Fixed Income in 15, I usually interview leaders, influential individuals from the world of finance and economics. So, who would you recommend that I ask to be a guest on a future episode of the show?
What do you want to learn from them? And I'll give you the guest.
We want kind of a big picture analysis that's someone coming from an interesting or new perspective.
I think the single most interesting person right now in the world, and I say that because so many people are cynical of the opinions held, is Cathie Wood from ARC.
Mm-hmm.
She's been a thought pioneer, or also James Anderson, who's just leaving Baillie Gifford. These people have looked at technology and said, you need to look at the adoption of this, and they've been very right. and that it's going to change all of our worlds. And cryptocurrency is just part of it. And they're both big crypto enthusiasts, but it's just part of this relentless drive towards digitization, massive data sets. I think people need to understand that the world of the past, like the fixed income world, has gone. That fixed income world by central banks, how we're not going to normalize this with the kind of debts that we've got and the demographics we've got. So people need to understand, okay, how do I make returns? Maybe DeFi is the answer. Maybe I can be involved in that and still meet my obligations to my pension holders, for example. So I think people need to look at it broadly and say, maybe the world has changed, and how can I do that? So somebody like Kathy would be extraordinary.
Great, fantastic. Well, thank you, Raoul. Thank you, Mohammed, for both your time today. It's been really very interesting, captivating, in fact. So thanks everyone for watching or listening if you're on Spotify, and see you next time on Fixed Income in 15.